or I guess I should do a little bit of an introduction. This is Tom Katozich, and he is with the Virginia Credit Union. And let's see, your official title is Youth and College Financial Education Manager, which we were chatting earlier. That entails quite a few different things. But Tom has come and done a couple different money workshops for teens at our library, and they're always great. They always teens tend to walk away with a lot of great information. And so I'm sure this is going to be the same. Our plan was to talk about credit today. And we were just discussing before you jumped on, Dion, if we didn't have anybody come, we might switch to a different topic and do a presentation that required less interaction. So, but now that you're here, we can go back to plan A. If you're up for playing some Kahoot and, kind of engaging that way, what do you think? You can feel free to type in the chat because I know you don't have the ability to learn. Okay. I like that.
Awesome. Very cool. All right, cool. Well, we'll go ahead and do the Kahoot if you are up for it, and feel free to type in the chat anytime if you have any specific questions or anything. Please feel free to stop along the way. The Kahoot's got a couple of poll questions up front just to kind of get a little bit of a feel for who you are and where you are at currently with your finances and understanding credit. And then there's like a lightning round in the middle that's really fun. It's like, is this going to help or hurt my credit? And then at the end, there's a quiz that kind of encompasses everything that we're going to kind of touch on here today. Credit can be a very complicated or complex topic, but hopefully I'm going to explain it today in a way that is relatively easy to understand. Some of these terms may be a little bit advanced, but that's okay. I don't want to talk down or think that you don't understand what we're saying. We're going to try to make this really, really simple to follow. So I'll go ahead and share my screen as I'm doing this. And Jen, feel free to play as well if you wanted to join in. A little bit about my background while you guys are getting logged in. This is the PIN number. It's 2780106. That's 2780106. I'm sure, Dion, you're familiar with Kahoot, being that we've all done nothing but virtual everything for the past year. You can go to kahoot.it on a separate browser on your computer, or you can access this on the Kahoot app if you have that on your phone. So I've been in banking for the last 15 years. I have my Master's of Business Administration, my MBA from Virginia Commonwealth University. I've been teaching financial education and literacy for the last 6 exclusively. And I really have a strong passion for helping people of, like a lot of times people learn about money by making mistakes. And there are some mistakes that are a little more or less forgiving than others. So with credit in particular, like if you make a couple bad mistakes early, that can really set you off on a really challenging path ahead. But if you're able to kind of educate yourself by being here at a presentation like this and learn the right steps, you can build a strong credit score. So we're going to talk a little bit about kind of why that matters. And if you got any specific questions or things that you've heard of before, there's a lot of myths out there. Don't hesitate to type in the chat. All right. So all things credit or money's not free. So first we have a couple of poll questions and just kind of some things to kind of get you start thinking about it. This is a little brain. Yes.
Sorry to interrupt, but I don't know if the same thing's happening to Dion, but mine is just loading.
Ooh, I don't know.
Dion, are you able to get in?
I see Dion's name.
Okay, good. Well, you go ahead without me then.
Okay. All right. At any time, Jen, if you'd like to join, the pin is located down in the bottom corner. All right. So fun little kind of starter question here, which Dion, I see you answered here. What would you rather have, a shopping spree or a dream vacation? I also would like the dream vacation. I'm a very much an experienced person. Some people, my wife would totally prefer the shopping spree, but I love to go do stuff and have these kinds of experiences, which is fun. So we're going to be talking a lot about debt today. So what is one word you would use to describe debt? And you can type it into word cloud. This is a word cloud question. So what is one word you would use to describe debt? And we're going to clarify the difference between debt and credit. Stressful, unavoidable. Okay. Stressful, yes. Unavoidable, not necessarily. It's very difficult to avoid debt, and it's actually not always the best idea to completely avoid debt, but you can do it, and there are people that do it. Yeah, we're gonna kind of touch on some of that as we go through here today. All right, last poll question: do you currently have a credit card? Oh, it's a credit card with 2 C's apparently. Okay, so we got 1 yes, 1 no. I got a guess as to who's the yes and who's the no, but we're going to go ahead and keep rolling along here. So these are the things that we're going to cover here today. What is credit? Why does it matter? What is the difference between good debt and bad debt? How the credit reporting system works? What a credit score is, because all of these things are kind of a little bit different. How to build credit, and then how to maintain a good score once you have one. Okay. A lot of people have a lot of different come at this situation from a lot of different angles. So we're going to try to cover everything here today. Again, this is a really, really deep topic. We're going to try to keep it light, and really hopefully you'll get out of this some actual tangible things that you can do or consider to start to build and keep a good credit score. Okay. So what is credit? Credit is the ability to borrow money. It's a reputation. Okay. There are these 3 companies, Equifax, Experian, and TransUnion, that create reports. All right. The report has financial information about you. All right. You don't really do anything with your credit report. It's somebody else is actually compiling or gathering that information about you. All right. So these 3 credit reports collect information like, do you currently have any loans? Are you paying those loans on time? Remember, credit is all about loans. Okay. Now, if you miss other payments, like, a bill that's a payment that's not a loan is something like a utility, like your Dominion power bill or your water bill. If you don't make those payments, that can actually hurt your score. It can make your score go down, and it will be reported to the credit bureaus after a certain period of time. With a loan, though, when you have a loan, that actually helps you build credit because you're borrowing money and paying it back on time. The whole purpose of this is to know or to guess whether or not you're going to pay somebody back on time. So your credit is your reputation. All right. It's your way to access financial services and other services. It's basically, how the financial services industry views you as an individual. Okay. So if that's what credit is, why does it matter? Well, if you ever want to borrow money, so one of the terms that was on there was unavoidable. If you want to get a student loan, you can do that without having any credit. You can go directly to the federal government, fill out your FAFSA form, apply for college if you get in, and get a student loan. If you ever want to buy a car or buy a house or start a business and you need to borrow money from a bank or a credit union to do that, they're going to check your score. Okay. And what your score is will determine, first off, whether or not you're going to be approved for the loan or not. And then second, how much you're going to actually pay for your loan. Okay. The amount of money that you pay in addition to the amount that you borrow. So the amount that you borrow is called your principal, and you repay that over time. And the additional charge is called interest. Okay. And your interest is expressed or shown as a rate. You see this middle column here says APR. All right. So your APR is your annual percentage rate. And the higher your credit score is, that means the better your credit is, the lower your interest rate is going to be. Okay. That means you're doing all of the right things according to the score to build up your score and have a good score, which will give you a good rate. Okay. So if you have a 760 score, or let's say you have the 720 score, your interest rate is going to be 3.95 on this car loan. Okay. Now, if you're young and you don't have a lot of credit history, or maybe you've had some financial struggles and missed a bunch of payments and your score is down here at 610, it's the same car, it's the same loan, but this one costs this person $576 where this costs $460. And that's every month over the course of 5 years. Okay. Now, not only does this impact whether or not you can borrow money and at what cost, but other implications are also at stake here. Employers will pull credit, insurance companies will pull credit, rental companies, if you want to rent an apartment or lease a car, those places are going to pull credit. Even utility companies are going to pull credit to make sure if you're more likely to default on a loan or miss a payment, then you're more likely to miss a payment or a bill with some of these other places. With employers too, like especially if you work in law enforcement or the financial services industry, you're seen as a higher risk if you have a lot of debt or a bad credit score, because you're more easily influenced by your outside financial situation. Okay, so this is actually really important stuff. All right, any questions so far, Jen or Dion, about what we've covered about like what credit is and why it's important? Okay. All right. So now we're going to talk about kind of the other end. So if credit is your ability to borrow money, everybody wants to have good credit, but once you have the whole point of having good credit is to be able to borrow money. And once you borrow money, then that turns into debt. Okay. And debt is something that's looked at on your net worth statement. Debt is actually a negative in terms of your cash, but it depends on what you're borrowing that money for. All right. So good uses of borrowing money, like a lot of times people think a good use of borrowing money is like if there's an emergency situation, like if my car breaks down, I can get a loan to get it fixed, or if I have some kind of medical emergency, I can get a loan to help pay for that medical emergency. Or like if my, something happens at my house or something like that. I'm here to tell you that that is an acceptable use of debt, but it's really not a good productive use of debt. When you borrow money, you want to make sure that you are gaining something financially out of that loan. Okay. So borrowing money to buy a house, borrowing money to get a reliable car that will get you to work. Those things will help you. Borrowing money to start a business, borrowing money to get a degree that will help you earn more money in the future. Those are all those are all broadly categorized as good or okay debt. Okay. A very, very powerful financial tool. So if I'm borrowing money, it better be paying me back more in the future than I'm going to pay in interest. All right. That's the way that I kind of look at it. Now, a car loan is one of those things that's kind of unique. All right. So if I borrow money to buy a car, the value of that car typically goes down in price over time, right? A brand new car becomes a used car becomes an old used car with a lot of miles, and that old used car becomes a junker that's like really old, a long time down the road. But even though that car loses value itself, which is called depreciation, it still helps you make money by being a reliable source of transportation to work. Nowadays, you would probably even classify, a good asset as like having a reliable internet connection and a good computer, or having a smartphone that allows you to connect to potential employers. Those are becoming as important economically as having a car in the past. Okay. Okay. So then if those are considered to be okay or good debts, then what is bad debts? Well, a bad debt is basically borrowing money, which this is really easy to do, borrowing money that you struggle to pay back, that you're just spending on stuff like clothes or vacations or gifts or like the holidays or whatever. And basically just living like beyond your means. All right. There are going to be different cycles or times in your life where you're going to need to rely on borrowing money, like credit cards, if you're in college or, in trade school trying to get through and you need to borrow some books or borrow money to buy some books. That's like, okay, but it's very easy to spiral out of control. So you always want to be really, really careful with credit cards, personal loans, and even car loans. Like there's going to be a good chance that someday, if you have good credit, you will be approved for a really big, huge car loan. But if you can't afford that car payment and you're struggling to make that payment, then your credit score is eventually going to end up going down if you miss it or if you're late. Okay, so you just always want to be kind of careful about it. Use debt, like you don't have to avoid it, but don't go crazy with it. Like that's kind of the whole part of it. Okay, so here's the credit reporting system in a nutshell. We talked about this a little bit. You have these three companies called Equifax, Experian, and TransUnion. There's some common terms you may hear for them are credit reporting agencies or credit bureaus. I'm here to tell you that they are not agencies or bureaus of any government body. They're actually private for-profit companies that are in business to collect and sell information. So like Google, like a lot of times Google, they make a lot of money off of gathering data about their users and selling it to advertisers and things like that. That's kind of like this, but like way back from like the 80s. Okay. So you have these three companies that collect data. The information that they collect is personal identifying information. So who are you? Social security number, current and former addresses, current and former employers. If you get married and change your name, or if you just change your name in general, that kind of information is collected. A big chunk of what's on your credit report is what we call trade lines or your loans. So it's like, when did I originally get my loan? How much are my loan payments? What was the original balance of that loan? And the big thing that's captured is, do I make my payments on time? And there's actually little check boxes. Every time you make a payment on time, you'll see a little check box on your credit report. You can actually look at this yourself. Okay. Then there's the next section is around any public records. Okay, so this includes collections accounts, garnishments, liens, alimony, child support, anything that works through the legal system. That's public information, so that's also compiled on your credit report. And then the final section shows whether or not you're looking at your report or applying for loans regularly or frequently, which is not really a good thing. That's called an inquiry, and it'll show up on your report for a couple years. We'll talk a little bit more about that when it comes to your score. Okay, so a score is an algorithm or like a calculation of all of the information that I just described, and it's puts into this computer system and it spits out this number. Okay, and the number is your credit score. All right. Your credit score changes. Like your credit score only reflects all of the information that's currently on that report at any given time. Okay. Now the customer, the customer of the credit reporting system is not you. You're the product. You as an individual, you're what's being bought and sold. Your data is what's being bought and sold. The customer are places like Virginia Credit Union and Wells Fargo and Bank of America and Capital One and lenders, people that you are asking to borrow money from, car dealerships, all these kinds of places. Again, employers, utility companies, insurance companies, anybody that wants to know whether or not you're going to be a high risk of defaulting or not repaying a loan. That's what this whole system is about. Another little secret too is like having a couple blemishes here and there on your report is actually really good for the lenders, because we're able to charge more money if your credit isn't perfect. So you really want to maximize your use of the system. You want your credit to be perfect if you can. It's sometimes not easy to do though. And it's okay, because everything on here, everything that we're talking about, the only thing that stays on your report forever, that will never, ever, ever come off your report is if you get behind with Uncle Sam. Like unpaid taxes are the only thing that will permanently stay on your report. Everything else though has a shelf life. Everything else will roll off eventually. All right. But you don't want to be in that situation. You want to try to stay ahead of this stuff. Okay. So any questions so far about that? We're going to kind of get into a little bit. I know that this is kind of sophisticated stuff, but is it all making sense to this point? Okay, great. Thank you. All right. All right. So now we're going to dig in a little bit about what makes up your score. And then we're going to play a quick lightning round of will it hurt or help? All right. You typically there are 5 components broadly that make up your FICO score. You have your payment history, amounts owed, or what's a better term for that is your credit utilization ratio, which we'll talk about that in a second. length of credit history, new credit, and types of credit. Okay, so these are as defined by FICO. Now you'll see these other terms here like FICO score. So FICO score is a particular type, a specific type of score, all right, that's used by your reports. Most lenders like Virginia Credit Union and Bank of America and Capital One still use some version of the FICO score. If you go onto a website like Credit Karma, or if you go directly to any of these credit bureaus themselves, there's this other scoring model called Vantage Score, which is a different type of scoring model. Like if you go onto Experian and use that boost thing that you see on TV, it doesn't really do a whole lot because it boosts your, it looks basically what that Experian boost does is it adds on your payments of other stuff like your utilities and your Spotify and Netflix, which you can't really not pay Netflix because you have to set it up automatically, but they count that as like positive payment history. The only thing is like it only shows on your app. Like if you come into the credit union, we're going to look at your Equifax score and your FICO model. So your Experian boost doesn't really help with that, if that makes sense. Okay, so the components of the FICO score, which is the most important, number one thing is your payment history. Are you paying your bills on time? Things that will help your score, obviously, are paying your bills on time. Things that hurt your score are missing payments and defaulting on loans. Now, how badly those things hurt your score depends on a lot of these other factors. And it also depends on how late you were to get caught up. So like if you're 30 days late and then pay it, then it'll show as a 30-day late payment. If you're 60 days late and then you repay it, it'll show as a 60-day late payment. If you're 90 days late, then it'll show as a 90-day payment. The worse it is, the farther in time you get from repaying that loan, then the more it's going to hurt your score. Okay. Now, with that being said, the farther in time you get from that negative incident, it also kind of hurts a little bit less. Okay. So if I have a financial troubles now, let's say last year I had a problem because I lost my job because of COVID. A lot of stuff has been changed or held up because of COVID, but like if I'm not able to make my pay my bills, last year, it's going to really hurt my score. But this year, those incidents, once I get caught up, then those incidents will hurt a little bit less. Next year, those things from 2 years ago will hurt a little bit less, so on and so forth. Negative or derogatory information will actually stay on your report for 7 years. All right, 7 years. So this stuff does fall off eventually, but it does also hang around for a while. All right. So number one thing is just make sure you're paying all of your bills on time all the time. Only loans will help build your score, but missing other payments like medical bills and I don't even know, like utility payments, cell phone payments, that kind of stuff. It doesn't always immediately hurt your score, but if it gets to the point where they're sending that information to collections, to a collections agency or company, then it will go on your score and it'll hurt you. Okay, so this is why all this stuff is kind of important. The second biggest piece, and if you're able to kind of get these two things in a good spot, you're really going to be in really good shape, is your amounts owed. Okay, so Dion, for like a credit card, the way a credit card works is you're typically given a limit, okay, like an amount, all right? For young folks, the limit is usually like 250, 500, maybe $1,000, all right? That's the amount that you have access to. If you spend all of that money, then you've maxed that credit card out. The way that it's calculated on your score is a ratio. So it's a fraction. Okay. So the limit is my denominator. It's my bottom number. How much I spend is the numerator. It's the top number. I want to make sure that that fraction is low as possible. Okay. So if I have basically like if you have a $500 credit card, don't spend more than like $200 on it. Okay. If you have $1,000 credit card, don't spend more than like $300 on it. You want to keep it to 30% or less. All right. Over time, as you become more financially stable and sophisticated in using your credit, it's actually okay or good to have a lot of credit that you don't use. Right. Like I have like 5 credit cards. I only use like 2 of them regularly, and I rarely keep a balance on any of them at all. Like I use them and pay them off. I do use them, but I use them and pay them off. Like that is actually very helpful for my score. Okay. So like if somebody offers you a $10,000 credit card, you have to have the discipline not to charge it up to $10,000, but it's actually good for your score. I know it sounds kind of silly, but that's the way that it works. Length of credit history. You want to get started early, young. I assume, Dion, that was you that said that you don't have a credit card yet. Getting a credit card when you're young is actually very helpful. Being an authorized signer of a parent's credit card or a guardian's credit card, somebody that you trust, can also help you start to build credit early. If you walk in just straight off the street to a car dealership and say, hey, I want to get a car loan from you, they're likely going to say no, or they're going to say yes, but charge you a really, really high interest rate because you don't have any credit history. So, in order to even have a score, you have to have one loan or line of credit for at least 6 months. New credit that's what has to do with those inquiries. So if you pull your credit a lot, it will actually hurt your score. But the only way to build up your score positively is to apply for credit. So it's okay, especially when you're starting out, to apply for a couple. Don't go crazy. But once you have your credit score established, try to only apply for one loan, whether it's a credit card or a car loan or a home loan, at the minimum time frame, like 6 months to a year apart. This is going to be really important because if you want to buy a house someday, you're going to have all of these things already documented on your report to have a good solid score to get approved for the loan. Again, like, I'm not making the rules, I'm just telling you how it works. So types of current credit, that's another one that's looked at. Here's some other information about all of these things. Have a good mix of credit. Like if you only have a credit card or if you only have a car loan, it's what we call a thin file. And so we're much less likely to lend you money for a big purchase like a house. Another good tip, this slide just reminded me, with length of credit history, whatever credit card you get first, you want to keep it open forever. So the best advice is to try to find a credit card that will accept you, that will approve you. Preferably something that has no fees. Don't really have to worry about the interest rate. You don't really have to worry about it's good to have some kind of a reward, but you really want to make sure that there's no fees on it, and then use it and pay it off. Use it and pay it off. Use it and pay it off. That's the best way to start to build credit. All right. So quick quiz. This is lightning round. Help or hurt? If you miss a car loan payment, will this help or hurt your score? This is lightning round. Very quick. All right. Excellent. Hurt. Correct. All right. Dion, fast finger. All right. Quick. Help or hurt? Your credit limit is 100, but you only have, or 1,000, but you've only spent 100. Excellent. Excellent job. All right. You guys must already know a lot of this stuff, which is great. We're reinforcing stuff. Help or hurt? You don't get a loan or credit card until you're 30. Is that going to help or hurt? Excellent. Wonderful. All right. Dion, on fire. Help or hurt? You have a car loan, a credit card, and a student loan. Is this going to help or hurt your score? See, this is a little bit more tricky. This one's always a little bit more tricky. Help, exactly. That will actually help your score, because remember, that credit mix does actually help your score. You have a good file with good payment history, and so we're very likely to lend you money. All right, last one in our, Jen took the lead. Last one in our lightning round. Okay, help or hurt? You apply for a credit card at 5 different stores in 1 week. Is that going to help or hurt your score? Excellent. All right, cool. Man, you guys are credit experts. Okay. So how do you get started? If you're under the age of 18, you're not legally allowed to sign a loan contract on your own, because you're not considered an adult. So any legal contracts that you sign is null and void, but you can be added as an authorized user to an adult. So what that means is you're issued a credit card in your name that is associated with their account. So it's still theirs, but you got a card. And what that does is that kind of activates you in the credit reporting system. There is no underage limit. There is no limit on the low end of that legally. Different banks and credit unions have different policies though. So they may say like, okay, you're 13 years old, 14, you may not be eligible to be an authorized user yet. That's probably around the age that I'm going to start to have my daughters to build credit on with us. If you're over 18, You want to try to apply for an unsecured credit card at a bank or a credit union, preferably where you already do your banking. They're most likely to give you a loan because you already have some kind of history with them. Jen is saying that she did this with her parents and used gas cards just to buy gas. That's the most common way to do that. If you got a car, use a credit card to buy gas and pay it off, buy gas and pay it off. All right. If you get declined with your first attempt to get a regular credit card, that's okay. You can try to get what's called a secured credit card or a secured loan. So it's kind of like a prepaid debit card, but different because it's actually a line of credit. Sometimes there are going to be fees. A lot of times with secured cards, there's like an annual fee on it or an interest rate that you're going to have to pay. But what you do basically is you save up some money and you deposit it into a savings account with a bank or a credit union, and they will give you a loan or a credit card for the exact same amount. And then you use it and pay it off just like a regular loan or credit card. Another option would be to co-sign a loan with an adult that has good credit. I want to warn you though about co-signing. Always be very careful. If you care about your credit at all, guard it with your life, because if somebody else can mess up your credit, like we see more people whose credit is damaged by a family member, by a brother or cousin or parent. If you get married, like that can, and divorce, that can create a lot of credit problems. So always be very cautious about co-signing with anybody. Okay. Okay. So how to keep a score really good and solid and healthy. Pay your bills on time all the time. Absolutely do that. Make sure your loan payments will actually contribute to a positive history. So you need to have it. So when that statement at the beginning with debt is unavoidable, it kind of is. Like it kind of is. Amounts owed, you want to make sure that you're keeping your balance below 30% of your limit on credit cards. Your amounts owed ratio doesn't really have a whole lot to do with like car loans or home loans. Those are what are called fixed loans, not revolving loans like a credit card. Length of credit history, you want to make sure that you're keeping your old accounts open as long as possible. That's why a credit card is really important, because if your first loan is a car loan, eventually you're going to pay that off and it'll be over. Okay, so if your first loan is a car loan, like a parent co-signs with you on a car loan or something like that, soon after you get that, you should try to get a credit card, because you can keep a credit card open forever. Okay. A lot of times, people in financial services or even your economics or personal finance teacher are going to try to scare you to death about credit cards. And you should be a little bit scared of credit cards, but don't be scared of them to the point where you don't use them. Be smart about it though. Okay. Types of current credit. This will kind of come, as you age and need different loan products. Always make sure you check your report for errors. Okay. This is your reputation on the line. These credit reporting companies are not perfect. And so if you have a name that's similar to a family member, like if you're a junior or a senior or a third or whatever, fourth or fifth or sixth, there is a chance that there could be like some inaccurate or false information on your report. Okay. So you want to go to annualcreditreport.com to check that. All right. If you don't have any loans or anything yet, you may not even be in the system yet. Typically, you don't even have a score until you have at least 6 months of a loan. And that could be a student loan that's in deferment. That could be a credit card. That could be an authorized user of a credit card. You have to have something for at least 6 months before you even get a score. Okay. How to rebuild a score. A lot of the same ways that you would start from scratch, but one of the big things is if you get behind, all right, if you get behind and miss some payments, it's okay. Like it's not the end of the world. Having your score go down for a while is not the end of the world. It takes time to rebuild it. It does take some time to rebuild it. So first thing you want to do is make sure you get caught up on anything you're past due on. Right. If it ends up being a lot of stuff and you start to talk to somebody about bankruptcy, that's a legal procedure or legal proceeding where you basically like have a lot of loans and debt and stuff like that you've accrued. You may lose your job. It's not optimal, but it is something that you can do. Basically, a court will determine whether or not you're eligible to do this, and you basically don't have to repay your loans. Your credit will take a big hit. It's going to be very tough for you to start to borrow money again, because if you walk away from other loans, then people are going to be like, oh, I don't know if I want to lend money to that guy or person. Okay, so make sure you're looking at your credit report. If there are any errors, you want to dispute them. Try to pay down your debts and balances. This is another one, like, you know, because you're looking at that ratio. Actually applying for more credit or new credit will help your score, because if you think about it, you want to try to replace bad credit history with new good credit. So just make sure you're paying all your bills on time. Try to get caught up. Here's another really great tip. If you know for a fact that your finances are going to change and it's going to make it difficult for you to pay your bills or repay your bills, proactively reach out to your bill collectors. Okay, if you know that you lost your job or you're going to be short on your car payment, don't just let it slide and try to pay it late. Talk to them ahead of time. In any and every scenario, try to talk to them ahead of time, because they're more likely to work for you. The reality is, like, you know, I say we as like lenders, we want you to pay us back. We want you to pay us back. So if it's not like the full amount, it may still ding you, it may still sting a little bit like on your credit, but we want you to be proactive about it. You are much more likely to have a positive outcome if you call us and say, hey, I'm going to be late, or, you know, there may be a fee, but, and if also if it's like another type of bill or something like that, ask them what their credit reporting policies are. It's like, how long do I have to pay before you're going to report this to my credit bureau? That's another good question to ask. Okay, but don't think that if you just ignore it, it'll go away. That's absolutely the worst approach to take with any financial problem that you're having. Okay. All right. The Fair Credit Reporting Act states that every 12 months you are allowed to see a copy of your credit report from each of those 3 credit bureaus for free. Remember, that's Equifax, Experian, and TransUnion. And the website that you want to go to access those is annualcreditreport.com. Okay, that's sanctioned by the federal government. It's a trusted location. The reason that I say this, and everybody emphasizes this particular site, is because you have to input your personal identifying information. You have to put your social security number in. You have to put in your all of your personal identifying information to get your credit report. Don't do that on just any site. Be very careful with that information. Okay. Pulling your own report will never hurt your score, no matter what anybody tells you. I know there's a lot of misinformation out there about that. Like, if I keep checking my score, if I keep checking my report, they're gonna ding me. That does not actually happen. Okay. Now, your report is different than your score. When you go to annualcreditreport.com, you're able to review your report, but it will not show you your FICO score or your Vantage score. You have to go to a different source to get that. A lot of credit card companies and banks are starting to give that away for free now as a added value benefit to having their card. If you're a member of Virginia Credit Union, every quarter, one time every 3 months, we will show you your your Equifax FICO 8 score. Every 3 months, we'll show that to you for free on our app. Okay. All right. So all that being said, we got a couple questions to kind of see what you've learned. And then if you got any questions for me, I'd be happy to address anything specific. All right. So here's our first question. What is debt? Money that you borrowed that must be repaid, a type of card connected to your checking account, money that you earn from doing work, or, okay, excellent. Yes, correct. So debt, remember, debt is having credit is looking forward. Once I have a loan, then it becomes debt. All right. So I've already borrowed the money. Now I got to repay it. All right. There is always a cost to debt, always a cost of debt. All right. Excellent job. Jen is on fire. Wonderful. All right. Quiz question. What is credit? Okay. So what is credit? Your reputation, access to loans and financial services, your ability to borrow money, or all of the above. Correct. All of the above. It is absolutely is all of those things. All right. And just like with your reputation at school or within your family, it's like a trust thing. Your credit can very easily and quickly be damaged, but it takes some time to rebuild it. Okay. So, you know, if you do something messed up towards your family, you know, they will end up forgiving you over time, but it does take time. It's not just going to happen overnight. If you mess up something on your credit, you can be forgiven, you can be re-entered into the system. Now, whether or not the system is fair, that's a different conversation for a different time. I would gladly have that. Dion on fire. Look at this. This is a tight game here. Okay, so type your answer in here. How many components make up your FICO score? So we went through those components. How many are there? You can type in either the number or spell it out. And just like with the other questions, the faster you do it, the more points you'll get. Excellent. All right, wonderful. Okay. Got a close one here. All right, so the best way to keep your credit score good is to have multiple different types of credit, keep your old accounts open long time, pay all payments on time, or all of the above. I didn't notice that I had two all of the aboves. That's a dead giveaway. That's always a dead giveaway. All right, let's check. Final question here. This is the last question. True or false? You should always pay yourself first, save before taking care of other bills. This is a very controversial question, and I've had people talk to me about this one. I am a pay yourself first fanatic. So you want to make sure that you're in a situation where you are able to save some money out of every paycheck before you are paying your bills. So what that means is you have to really think about how to manage your cash flow. You have to really be very thoughtful and considerate when taking on a new bill. I know there are some bills that you can't avoid, like rent or utilities, but you have to be very, very mindful about prioritizing your saving over other bills. Now, when it comes to your credit, if you don't pay your other bills, then your credit score will go down. There will be a damage to your credit. But again, like I'm a huge pay yourself first above everything. That's how you start to build wealth, and that's how you start to move yourself forward. All right. So thank you so much. Here's my contact information down here. This is my coworker, Tori, who helped me create this program, this PowerPoint. And we're going to take a look at our final leaderboard here. And Jen, if you want to open it up for any questions. Dion, you really did a fantastic job. And Jen, of course, you did wonderful as well.
All right. Yeah, if Dion, if you have any questions, you can feel free to post those in the chat or in the Q&A, whichever you prefer. All right, she has one already. Great. How reliable / good are credit score apps like Credit Karma?
Great question. I get that a lot, especially from younger folks who see it online all the time. It's an okay service. I'm not a big fan of doing anything online that's free when it comes to my finances or my personal information, because if it's free, they're trying to get you to click on other links or potentially collecting your information and selling it to other people. That's their business model. Like the way that Credit Karma makes their money is they'll suggest to help you build your credit score. You apply for this certain loan. It may actually do that. It may actually help your credit score, but I'm just personally not a big fan of the way that they, make money off of that kind of those affiliated links and things like that. In terms of the score itself, as I mentioned during our presentation, the Credit Karma score that they give you is your Vantage score using only one, maybe two. I think it's your TransUnion report, and using your Vantage score. So what that means is they're going to give you a number, like they'll give you a number, and that number is reflective of this scoring model with this information. Now, the information on your TransUnion report and your Equifax report and your Experian report are all going to be really similar, but not always are they going to collect and capture everything. Okay, so there may be something that shows up on one report that doesn't show up on the other two. Most of them do capture all of the information in today, like now. It used to be much more common that like TransUnion would only capture stuff that like happened if you live out in the West Coast, and if you move to the East Coast, Equifax would get it. I will tell you this: if you look at a score like your Credit Karma score, and you say like, okay, my score is a 580, I'm going to go into the credit union and apply for a car loan, and I'm going to say like my score is a 580. That's a good score. I can get approved for a loan, or that's an okay score. I can get approved for a loan. When we pull your credit report, we're going to pull your Equifax report, and we're going to use your FICO score. So I, as the lender, don't really care what your Credit Karma app is telling you. When my Equifax report is showing me that your score is a 540, that's what I'm going to base my decision on. I hope that makes sense. It gives you reasonably good information, and I guess kind of a okay starting point. And a lot of times the Vantage score and the FICO score components line up close enough to where it's like, okay, if I do have another line of credit, or if I do get caught up on this, or if I, whatever, it will help my FICO score as well. It's just not perfectly aligned. So that's kind of a wishy-washy answer. I don't use it. I don't particularly promote it, but I don't I don't hate on it either. Like, I know a lot of people use it and they get value out of it.
So if used, it should be used more as an estimate rather than an exact accurate number.
Perfect. That's exactly a great way to describe that. And to kind of throw another thing out there, like whenever you're like your actual score is a snapshot. Okay. So like, this is a great example. And I use this example in another presentation where I have this slide that shows my actual score over the course of 3 different months. Because like, and one of them is like right before Christmas, the other one is right after Christmas, and the other one is a month later. So it's like right before Christmas, my balance on my credit cards was really high. I got a daughter and we spent a lot of money, after Christmas, my paycheck came in and I paid it off. So my balance went back down and my score shot back up. And then the next month we had to take our dog in for surgery. And so the balance was back up. And so my score went back down. So even when you're looking at that, like from day to day, it can fluctuate. When it's really important for you to make sure that it is at its peak, though, at its highest, is when you're getting ready to go in and apply for a big loan. Like before you go get a car loan, before you try to get a mortgage, that's when you want to make sure your credit score is at its peak. Okay. So you do that by, you always want to make sure you're making your payments on time. That's how you maintain it. And then right before you're getting ready to apply for a big loan, don't apply for any other loans for like at least 3 to 6 months beforehand, and try to pay down your balances on anything that you have, like credit cards or anything like that. It's one of those things that's like, you always need to keep it in the back of your mind, but there are certain times where it needs to be a very, very high focus. And really it's that buying that house, like that's the difference between getting approved for a home and changing your entire family's generational wealth, or paying more in interest on your loan. So,
and correct me if I'm wrong, but those Credit Karma apps or other apps like that, they're just basic in that they show you the score that they've come up with. They're not like getting a very detailed view into your FICO score with your accounts and all
right.
that, so that you can be monitoring that it's correct, that nobody's stolen your identity and opened
So,
up a bunch of things.
some of them do actually do that. And Credit Karma, I do think does that, where they don't necessarily monitor your credit for you. Like there are services that you can purchase that do credit monitoring. Again, because you're able to look at it yourself regularly enough, you don't really need to do that, I think. But yeah. And you got to remember too, Jen, like there's a difference between the Vantage score that they give and the FICO score that we use.
Right.
So again, like Dion mentioned, it's a good estimator, it's not like number for number,
Right.
even day to day, it's not like, that specific. But again, like annual credit report's a good place to go. And the way that I do it, if you want to check to make sure your credit is safe and good, every 4 months, I will look at a different report. So like I actually put it on my calendar. The last one that I pulled was TransUnion. 2 months from now, because this was 2 months ago, 2 months from now, I'm going to pull my Experian. 4 months from then, I'm going to pull my Equifax. 4 months from then, I'm going to go back to my TransUnion, and I'm monitoring my credit myself. I'm not a big fan of paying for that stuff because I want to save my money. So there are services out there that you can pay for, like LifeLock and all of these other identity theft and credit monitoring services. And you don't necessarily need to do that.
Okay, good to know. Any other questions before we wrap up? All right.
Dion, you did a great job, Dion. Like you're already, the fact that you showed up to this and you grasped and understood like all of that and answered all the questions right, you're going to have a good score. You're going to have a really good score.
Yeah. Yeah. And it's great that you're starting this early too, to be thinking about these things. I realized that I didn't introduce myself at the beginning of this workshop because Dion does know me. But for those of you, we are going to be posting this video to the Richmond Public Library's YouTube channel. So for those of you that don't know me, my name is Jen Duell. I'm the young adult coordinator with our library system. And if you would like us to host more teen money workshops with the Virginia Credit Union, please reach out and let us know, because we are happy to do that moving forward. Tom's always great about coming in when we ask. And I know you have a bunch of other good workshops sort of up your sleeve as well. So
yeah, if you guys want, we got stuff around like banking basics, like understanding how to manage a checking account, creating a cash flow statement and a budget, like budgeting. We have one, I created one very recently about building generational wealth and understanding how to save and invest and really make your money grow for you. And we also have a really good one around identifying scams and identity theft. How to just kind of be mindful of, when people are talking about stuff that's too good to be true, oftentimes it is. So
yeah.
happy to come back and partner with you anytime.
Great. Well, just reach out to our library on the website. You can send an email to the cyber librarian if you'd like to see us bring one of these workshops to our library. Tom, thank you for hosting today. Always great. Dion, thanks for joining. And I hope you guys all have a wonderful day. All right. Thanks, everybody. Bye.
Thank you.